Welcome back to another episode of Investing Explained. Here's today's question. The short answer is no. You need to understand all the other variables before you can make an intrinsic value assessment of a specific stock and to create a successful portfolio. And perhaps I can best illustrate this by the valuation process of a company like Facebook. If you want to estimate the intrinsic value, your starting point has to be the normalized cash flows. And basically that means what will a company make in a normal year. And before you can make that assessment, you really need to understand the business in depth, because the number that you read in the financial statements are likely not the normalized free cash flows. Perhaps they are investing more or less than usual, and perhaps they're top of the cycle. This is all something you need to include in your analysis. And even when you have your normalized cash flow, you still have to project the potential growth scenarios. So one thing is to understand the business, but also really to understand the industry that they're operating in. So for Facebook, you might say that digital advertising is growing, say, 15% per year, and you use that as your short-term growth rate. Or you might have a qualified estimate why you think that Facebook would take market share in that market. Plus, you also have to include if you have reasons to believe that Facebook can make money from other initiatives, say the new crypto initiative, Libra. And your estimate of the value really depends on those growth projections too. So while there's no reason to make stock investing more complicated than it really is, if you look at this in the perspective of constructing a portfolio, you can have many stocks that you estimate are undervalued, but you also have to consider correlation and which underlying factors that can influence the health of the entire portfolio. So, Andre, really to answer your question, and I know I said the short version was no, this was the longer version, and I would say that the intrinsic value assessment is what comes after you understand all the other variables, rather than your starting point for building a stock portfolio.
I like your question a lot because you seem to have a deep appreciation for how difficult stock picking is. It is not easy, and I'm going to answer your question a little bit differently than Stig did since he addressed the question head on. So here's what I want to tell you. If you decide that you want to pick individual stocks, I think it's so important for you to understand the importance of having at least 10 to 15 different picks. And if you can make those uncorrelated picks, that's even better. Because the fact of the matter is you're definitely going to make mistakes. And if you participate in the markets long enough, you're going to put on a bad position. And by having at least 10 to 15 positions in your portfolio, you'll at least limit your downside risk and allow yourself the opportunity to learn and continue to optimize your approach as you're moving forward. The intrinsic value is a vital part of the process. If you don't have an idea of what the intrinsic value is, you probably should not be investing in stocks. It's no different than buying a business on Main Street. If you were going to buy a small business, if you don't know what the return's going to be for your down payment or for your investment, you're most likely going to have a very volatile experience owning that business. And you know what? Like owning a small business, it might work out. And I would attribute that if you didn't come up with a valuation and you just started a business on a whim and didn't do any of that math and it ended up being successful, I would argue that it was probably more attributed to the luck or just your sheer passion for what you were doing. And it's probably a lot lower likelihood of being successful because most of that is going to be masked behind luck. And so I would tell you that stock investing is not much different than that scenario. So when you're investing, you need to think of it in that light. Like Stig said, the other factors beyond the valuation are vital, especially if you're trying to come up with an expectation for what you think those growth rates are and what the potential risks are moving into the coming 5 to 10 years. So try to understand what those are, and then once you understand what those are, try to quantify that and conservatively build that into your valuation and your intrinsic value.
That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.